Everyone, welcome back. Today we learn about the economic cycle, a global analysis to understanding the rhythmic fluctuation of economies from expansion to recession and learning how to anticipate, measure, and leverage them for smarter financial decisions. What are economic cycles? By definition, an economic cycle refers to the fluctuation levels of economic activity that an economy experiences over time. These fluctuations are measured primarily by gross domestic product (GDP) and alternate between phases of expansion and contractions. Economic cycles are irregular in duration, but follow a recognizable pattern. They are driven by internal dynamics, investment, consumption, and external shock, policy, geopolitics. The four phases of an economic cycle: expansion, peak, contraction, trough. Each phase has distinct characteristics. The expansion phase sees rising GDP and employment. The peak marks the turning point before contraction. The trough is the lowest point after which recovery begins. This phase repeats cyclically, faults their duration and intensity vary. Key formula and indicator. The GBT growth rate. This is the formula in the slide. Output gap. This is the formula on the slide. The key indicator. GDP, unemployment rate, inflation CPI, and interest rates. When and why use economic cycle analysis? In investment strategy, in policy design, in business planning, and in risk management. Theoretical example, calculating the output gap. This is the scenarios. A country has a potential GDP of $20 trillion due to a demand shock. Its actual GDP falls to $18.5 trillion. This is a calculation. After calculation, we have a output gap minus 7.5%. A negative output gate of minus 7.5% indicate the economy is underperforming, a clear signal of a contractionary phases. Policymakers might respond with stimulus measures. The real world example. The 20 the, the 2008 financial crisis. What happened? The collapse of Lehman Brothers in September 2008 triggered a global contraction. US GDP shrunk by minus 2.5% in 2009, the deepest recession since the 1930 cycle. Unemployment rose from 5% to 10%. Global trade fell by 12%. Federal Reserve cut rate to near zero. Recovery took over 6 years. Global cycle pattern, K data. 7 to 10 average cycle length. Minus 4.4% COVID-19 contraction. 5.9% 2021 rebound. 3.2% long-term trends. Expert advice: how to profit from economic cycle. Rotate your portfolio. Time real estate investment. Follow central bank signals. This is a key takeaway. Cycles are inevitable. Measure GDP, jobless inflation, time investment and policy. Follow leading indication. Remember this. Economic cycles are not random. They follow identifiable pattern. By mastering cycle analysis, investors, businesses, and policymakers can make smarter, more timely decisions. Track GDP growth and output gaps regularly. Align your strategy with the current cycle phase, and use leading indicators to anticipate turning points. That's for today, guys. Thank you very much. See you soon.